The trust paradox. They say money makes the world go round, but that's a lie. The harsh reality is, in modern America, the world is run by debt. Debt is our hidden engine. Look inside your wallet. The thin piece of plastic you hold represents over $1 trillion in collective national debt. It didn't just change how you shop, it changed how you think about ownership. It is arguably the most efficient financial machine ever invented, and yet it remains the most misunderstood. How did a nation founded on personal responsibility normalize a $17,000 credit card balance? Today, we're unpacking the untold financial history of the credit card to show how this unassuming plastic quietly built one of the most profitable and powerful industries on the planet.
Diners Club, the rare credit. To understand this revolution, you have to rewind. Before the 1950s, credit wasn't a universal right. It was nearly impossible to get. It was a personal affair, based on a handshake and your standing with a local banker. If you wanted to borrow, your life was logged in a thick, heavy ledger. This system was simply too slow for a consuming, expanding America. But the first solution wasn't about debt at all. In 1950, a businessman named Frank McNamara forgot his wallet at a restaurant, and the Diners Club was born. It was an elite convenience card, a badge of access. And here's the crucial detail. You had to pay the bill in full at the end of the month. This wasn't debt. This was trust. Bank AmeriCard, the birth of debt. The real pivot arrived just 8 years later, in 1958, courtesy of the Bank of America in California. They realized convenience was fine, but interest profit was forever. They launched the Bank AmeriCard, the future Visa. And here was their genius, catastrophic move, the invention of revolving credit. You no longer had to pay it all back. You could pay a minimum balance and carry the rest over, allowing the bank to charge that sweet exponential interest. This was the moment plastic transformed from a tool of convenience into a profit engine of debt. The business was built not on paying back, but on paying forever. That single switch is what created the entire trillion-dollar industry you see today.
The true source of wealth. Transaction fees. When we talk about profit, our mind, conditioned by advertising, immediately focuses on high interest rates. And that is certainly one major revenue stream. But for giants like Visa and MasterCard, their primary, safest, and least risky source of wealth is not so much your debt as it is transaction fees. This is arguably the most efficient and hidden tax in the world, which the merchant pays on every single purchase. Think about the structure. 2 to 3% of every transaction, instantly, automatically, and without any credit risk to them, flows directly to the payment networks and the issuing banks. This process is seamless, it happens without your knowledge, and crucially, it occurs regardless of whether you pay interest or not. You might be the most disciplined payer on the planet, meticulously closing your balance on time every month, but you still cannot escape this fee. Visa and MasterCard are not banks in the classic sense. They do not issue the credit or bear the default risk. Instead, they function as infrastructure, acting as the financial equivalent of a highly automated, global toll bridge between every buyer and every seller on the planet. They charge a fee for passage, and this constant, automatic stream of revenue, which grows with global consumption and inflation, has made them some of the most consistently profitable, reliable, and expensive companies on Wall Street. While traditional credit issuers bear the colossal risk of loan default, Visa and MasterCard risk nothing, yet profit handsomely from every single movement of money within the global economy. This is pure monopoly profit, scaled to the size of the global economy, making their business model a case study in financial genius. This is precisely why, unlike the more volatile bank stocks, these bridges are often a cornerstone of stable, mature investor portfolios. Investor lesson number 1. This mechanism clearly demonstrates that the safest, most reliable investments are often those in infrastructure. You want to invest in the companies that own the essential conduits through which the economy flows. You can invest in these bridges that carry no credit risk but profit from every movement of money, capitalizing on the constant flow of commerce rather than the volatile risks of lending. Studying this risk-free business model is key to understanding how wealth truly flows through the modern system.
The FICO era, the code of power. To manage the surging tsunami of trillions of dollars in consumer debt, banks could no longer rely on personal handshakes and local banker knowledge. They urgently needed an automated, impersonal, and universally applicable risk assessment system. This pivotal requirement led to the emergence of FICO, Fair Isaac Corporation, in 1956, the three-digit code that has since become your definitive financial fingerprint. The credit card, in its expansion, gifted banks not just with masses of new debtors, but far more importantly, with access to an unprecedented volume of behavioral and financial data on every single one of us. The FICO score, often treated casually, is anything but. It dictates the fundamental price of your life for decades to come. It acts as the gatekeeper, deciding precisely how much you will pay for major life necessities like a mortgage, a car loan, or even your insurance premiums. The consequences are stark. If your score is low, capital becomes exorbitantly expensive and difficult to access, a financial drag that perpetually makes you poorer, even if your current income is otherwise high. Conversely, a high score grants you access to near-zero interest capital, accelerating your wealth accumulation. Financiers realize this truth early on. Whoever controls the information controls access to capital. Your FICO score is not merely a report. It is the master key that either opens the massive, luxurious doors to cheap capital, the fuel for rapid wealth generation, or locks you firmly into a shadowy world of expensive loans and perpetual struggle to keep up. Understanding this code is the single most critical component of financial literacy for the mature investor. Because by actively managing and optimizing your score, you are literally managing your access to and cost of capital, thereby controlling your long-term financial destiny. This system is not some esoteric magic. It is the refined science of data, risk control, and leveraged power. And serious investors pour vast sums into the companies that create and maintain this all-encompassing system. Credit and economic growth. Artificial respiration. The credit card isn't just a personal tool. It's a powerful, systemic instrument for the entire macroeconomy. It allows the Federal Reserve, the Fed, to effectively stimulate the economy, often bypassing the notoriously slow mechanisms of government spending programs. When the Fed moves to cut interest rates, credit cards immediately become cheaper, and Americans are incentivized to spend more, even if they lack the immediate cash reserves. This critical mechanism essentially allows the Fed to rapidly inject demand into the system and boost GDP during challenging times. Historically, during periods of recession or economic fear, when ordinary people typically tighten their belts and dramatically cut back on spending, the government and the banking sector actively use the card system to smooth the resulting sharp drop in consumer demand. Instead of an abrupt, catastrophic halt to purchasing, we simply roll over debt and postpone the reckoning, effectively giving the entire economy artificial respiration. But, like any artificial support, this stimulus comes at a massive structural cost. It relentlessly hooks the nation on a diet of permanent, exponentially growing debt, quietly transforming all of us into hostages to the system. Credit has become so systemic and absolutely fundamental to our economic structure, funding everything from retail to real estate, that the economy would face an immediate, catastrophic collapse if we collectively stopped spending. This presents a profound, terrifying paradox. We are compelled to bear the debt, not for personal gain,
but in order for the entire financial system not to break. It is a critical piece of financial education to understand that every single time you swipe your card, you are not just making a purchase, you are actively participating in this high-stakes macroeconomic game, where the long-term cost is always factored into the short-term convenience.
Two types of debt: leverage or chains. The history of the credit card offers the most fundamental lesson. Debt itself is neutral, but its utilization determines your wealth. The primary financial divide in America is this: the wealthy use debt as leverage to acquire assets that generate income. They secure cheap capital, high FICO, low interest, and invest it in real estate or businesses that yield more than the cost of borrowing. In this scenario, debt is an acceleration tool, allowing them to scale capital using OPM, other people's money. Every purchase made on credit for investment is a strategic move. Conversely, the middle class uses the credit card to acquire liabilities, consumption that generates no income and instantly loses value. When you fail to pay off the balance, debt becomes financial shackles. You pay 20% APR for something that has already depreciated. Here, compounding interest, the greatest force in the universe, works against you, silently draining your future potential. The key to freedom is permanently shifting this mindset. You must consciously choose the Diners Club philosophy, credit for convenience, paid in full monthly, and abandon the Bank AmeriCard model, perpetual, expensive, revolving debt. This paradigm shift is the first and most crucial step toward financial freedom. Stop paying for consumption and start forcing your capital to work for you.
Crises and the financial red flag. History proves that the credit card is one of the earliest and most reliable stress sensors for predicting impending economic crises. Just before the 2008 financial collapse, before Lehman Brothers fell, credit card debt reached absolute historic highs. Why? Because this metric is a direct indicator of the health and confidence of the average consumer, whose spending makes up 70% of the GDP. When credit cards are used to fund basic necessities, groceries, rent, rather than for convenience, it signals that the financial foundation of households is crumbling, and they are living on the artificial respiration of debt. The spike in delinquency rates, when people failed to make even the minimum payment, are direct, unambiguous signals that the consumption system is nearing a breaking point. Investor lesson number 2. As a seasoned investor, you must move beyond a pure focus on stocks and start monitoring these macroeconomic indicators. Study the reports on credit card utilization rates and delinquency levels. This data is your early warning system. If you see millions of people struggling with minimum payments, it is not the time for aggressive investments. It is the time for capital preservation and preparing to seek opportunities that will emerge after the inevitable correction. The credit card is the system's sensitive stress gauge. Learn to read that pulse.
The final lesson: time versus money. We are arriving at the deepest philosophical lesson the history of the credit card teaches us: the choice between immediate and delayed gratification. The credit card is the ultimate champion of immediate gratification. Its business model is built around selling you time, which you pay for with astronomical interest. You are purchasing an emotion, and the interest is the price of that emotion. In contrast, your retirement accounts, 401ks, IRAs, are the ultimate tools of delayed gratification, where you consciously sacrifice current consumption for a massive reward later, harnessing the power of compounding interest. These are two fundamentally opposed forces. The ultimate lesson from credit history is that you must consciously choose the power of delayed gratification. If you are spending money servicing consumer debt,
Those funds are actively working against your long-term goal, as your debt grows at 20% APR, while your investments struggle to reach 8%. This is a financial war you cannot win. Final strategy: focus your energy first and foremost on liquidating high-interest consumer debt. Every cent paid off is a guaranteed risk-free 20% return, the best investment you can make. Once you are free of those shackles, redirect all that energy into accumulating assets in tax-advantaged retirement accounts. Let the compounding interest that once worked for the bank now work for you. Credit as financial freedom. We have journeyed from the humble beginnings of the Diners Club to the global infrastructure of Visa and MasterCard, which moves trillions. The primary conclusion we must draw is the realization that the credit card is not merely a spending tool. It is a powerful financial lever that can work either for you or against you with relentless force. We learn that the true source of wealth for payment giants lies not in the high interest paid by a minority of debtors, but in transaction fees, a hidden tax paid on every single move you make, regardless of your personal discipline. This taught us that the safest investments are those in infrastructure, those toll bridges that profit from the continuous movement of the economy. This lesson should fundamentally change your investment approach. Look for risk-free transactional cash flows, not the volatile returns of lending. Furthermore, we saw how the FICO system became your financial fingerprint, dictating the price of your capital and ultimately determining the speed at which you can accumulate wealth. A high score is the master key to cheap money, allowing you to use debt as leverage to acquire assets. A low score is a perpetual sentence to servicing expensive loans, constantly dragging you down. This is the fundamental structure of power in the financial world. He who controls the risk information controls access to capital. Finally, we recognize the macroeconomic role of credit as the life support system for the entire economy. We as consumers are hostages to the system, compelled to spend to prevent collapse and bear an ever-increasing overhang of debt. This macroeconomic reality obligates us as investors to be vigilant. We must learn to read the red flags of consumer debt, the rise in card delinquencies, as an early indicator of an impending crisis, allowing us to preserve our capital. The final thought of this segment: your financial life boils down to a single choice. Will you harness the power of debt as leverage to create wealth, as banks and savvy investors do? Or will you allow it to become shackles that bind you to a cycle of consumption and payments? The time has come to embrace this power and consciously direct it.
Call to action. Become the owner. Now that you are armed with a complete understanding of how the credit system truly operates, it is time to transition from being a mere consumer to a strategic owner. You must start working with this system, not against it. Here is your actionable plan based on the lessons of credit history. 1. Optimize your FICO score. Your score is your access to cheap capital. Immediately take steps to maintain an impeccable credit history. Aim for a credit utilization rate below 10%. Never, under any circumstances, miss a payment. 2. Use debt only as Diners Club. Adopt the philosophy of convenience only and short-term settlement. Pay off your balance in full every single month. Abandon the notion that you can win by paying 20% APR for something that is losing its value. 3. Invest in infrastructure. Investor lesson number 1. Invest in the companies that own the economy's toll bridges, such as payment networks or essential infrastructure assets. They profit from all money movement, regardless of the state of debt. These are the most reliable, risk-free cash flows you can find. 4. Read the macroeconomic red flags. Investor lesson number 2. Become a market observer. Instead of just tracking stock prices, monitor consumer credit delinquency rates. This is your stress sensor, which will warn you of an impending recession long before the media starts talking about it.
This knowledge will allow you to protect your capital and be ready to purchase assets when the market dips. The final thought with which we close this series: the history of the credit card is not just a story of plastic, it is a story of power, discipline, and time. The money you spend chasing immediate gratification is your future self, which you are selling at a predatory price. Time is your most valuable asset. When you choose delayed gratification, you force compounding interest to work for you, not for the bank. From this moment forward, you are no longer just a participant in the system. You are a strategic investor who understands its structure and harnesses its power. Henceforth, every time you take out your credit card, remember, you are holding not just plastic, but a lever. Use it to build your wealth, not your shackles.